Three financial players that made their debut on the bourses this year are trading below their listing prices. High valuations commanded by the IPOs seem to be the common reason for their underperformance. Shraddha Babla is standing by with a closer look. Morning, Shraddha.
Morning, Neeraj. So, if you leave aside HDFC, AMC and Bandhan Bank, all the other BFSI companies which have made their stock market debut this year have actually given negative returns to investors. So, you look at ICICI Securities, it's down 36% from its issue price. ICICI Capital is down 19% and Credit Access Grameen is down about 10% just in the last 2 weeks since listing. To some extent, you could argue that the subscription numbers said it all already because if you look at the subscription numbers for ICICI Securities, it was subscribed just 0.78 times. Remember, it's the ICICI mutual fund schemes that had come to the rescue, even as the HNI and retail portions remained undersubscribed. In case of Indostar Capital, the total subscription was 6.8 times. Nevertheless, it was driven largely by the QIP portion, even as the retail portion was subscribed 1.5 times. In case of Credit Access Grameen, the total subscription was 2.22 times. Once again, it was the QIBs which had come to the rescue because the HNI and retail portion remained undersubscribed. Now, what went wrong or what is plaguing these companies? First, if we talk about ICICI Securities, recently we have seen a slowing down as far as the broking revenues are concerned. There was a flat 1% year-on-year growth even in the latest quarter numbers that were reported, and this is important because broking is the core business segment for the company, and we've seen a muted performance there despite ICICI Securities having the highest number of active clients. That apart, there is also all these regulatory and corporate governance linked issues. Remember, aside of the ICICI mutual fund schemes which came to the rescue of the IPO and the way it was pushed, you also recently had an advisory firm which had recommended not to vote for reappointing Chanda Kochar on board. You also have, more importantly, high valuation which could be weighing on the stock. The asking PE at the issue price for ICICI Securities was a 49.6 times its trailing earnings, a big premium compared to its other listed broking peers. Now, if you look at Indostar Capital, what the street probably doesn't like is its overall nature of the business, because it is mainly a corporate lender with a high real estate exposure. So corporate or wholesale lending forms 79% of its book as compared to the retail segment or retail financing, which is finding favor with investors these days. And nevertheless, the NBFC is making efforts to diversify into new lines of businesses. They've introduced housing and vehicle financing loans. Nevertheless, what analysts believe is that there is a long road to diversification. While it will take time for the NBFC to diversify, especially in a hyper-competitive environment, they believe that it will remain predominantly a wholesale lending NBFC, at least for the next few quarters. That apart, you also have low ROEs which could be weighing on the sentiment. The ROE stood at just 10.7%. Even the ROAs were extremely high at 5.5% in FY13, but they have come down to just 3.8% as of December 17 and are expected to fall further. When it comes to Credit Access Grameen, the key factor is the key concentration risk. Just two states contribute about 86% to the company's AUM. That apart, there have also been questions which have been raised about the company's long-term competitive positioning. If they are unable to offer any loans beyond the plain vanilla JLG loans, especially given the changing microfinance landscape where peers like Bandhan and Bharat Financial are taking other retail products to the doorsteps of the rural consumers. So that's one thing where the issue lies, as also suboptimal ROEs. ROEs were just at 11.8%, and this is pre-IPO dilution, so that was another concern. And finally, expensive valuations, because at the issue price, the stock was available at a multiple of 2.9 times price to book on a post-issue basis, again at a premium to what Satin Credit Care does. So overall, valuation didn't seem justified, and that probably tells you that IPO pricing remains a key issue, especially for NBFCs which have seen significant correction since or in the interest rate rising scenario.